Welcome everyone to this webinar. If you can hear me, type 1 in the questions window. If you can see the screen, and if you can see my camera. Excellent. Thank you, Carolina. If at any point you face any issues, please let me know. My name is Habib Hakiki. I am the Director of Research and Market Education with Daman Markets. I have a bachelor's degree in banking and finance, a master's degree in financial management from business school, Bocconi Business School in Milan, Italy. I'm also a certified technical analyst from the International Federation of Technical Analysts, and I have over 17 years of experience working with the top financial institutions in the MENA region, and as well 17 years of experience trading the international financial markets. So I think I'll be able to guide you nicely in this webinar. A very important topic we are discussing today, which is price action. So the language of candlesticks, one of my favorite indicators of all times. In technical analysis, there's a lot of indicators, trend indicators, momentum indicators, volatility indicators, volume indicators. But you know something? Most of these indicators are lagging. They follow the price. They do not predict the price. Now, what is the best indicator? Every time someone asks me this question, my reply is the same. It's always price. Price is the best indicator that you can use because it is a live indicator. It is moving based on the actions of the buyers and the sellers. It is reflecting the behavior of market participants. So in tonight's webinar, what we are going to do, we are going to discuss price action through candlesticks and learn how to use it to our own advantage. Hello, Josephine from Kenya. Nice to have you with us. I like my webinars to be as interactive as possible, so please do not hesitate to drop your questions and I'll make sure to answer them. This webinar is going to be interactive and practical at the same time, so let me know what market you'd like to analyze. I'll be using the live platform to show a lot of examples of everything we are going to explain, but at any point, if you want to analyze a certain asset class, a certain time frame, let me know. Drop me a message in the Q&A window. Yes, of course, XAU, AUD, USD. Thank you, Amin. Thank you. I'm gonna I'll make sure to cover all your favorite asset classes. I use candlesticks only, no indicator, and candlestick psychology is best for directions. Ramavat, I agree with you. That's exactly how I trade. And you know what they say, if you can trade a naked chart, then you are doing the right thing. I'm not saying we're not going to use indicators, but of course, if I am to choose one indicator, I will choose candlesticks. Price. Okay, so let's dig in. Let's start by defining technical analysis. What is technical analysis? It's the study of market behavior through the use of charts for the purpose of forecasting future price trends. So how do I study price action, market behavior? Market behavior is price action. How do I study price action on the charts? First, we need to illustrate the price action on a chart. And for that, we have several ways. One of the easiest ways to illustrate price action on a chart would be the use of the line chart. The line chart is this chart here. What this chart does, it simply connects the closing prices of each period. So let's say today I'm on a 1 hour chart. Every 1 hour, I see where did the candle, where is the 1 hour ended? What was the closing price of this 1 hour? And I put a dot. And then the next hour, I see where the price ended, the closing price of the 1 hour, and I drop another dot. And then I connect these dots so I get this simple line. Now, this line chart is practical. It tells me how price is moving, but it does not tell me the whole story. Looking at this chart, I can, I would think that this price here is the lowest price reached. And then this point here was the lowest price reached. However, if I switch from a line chart to a candlestick chart, you would see that this here, so again, this here was not the lowest price reached. Actually, the market went way below that point and even reached this point here. So this was the actual low, not this here. And this was the actual low, not this here. Now the line chart is useful for beginners. Okay, so if you are watching Bloomberg TV or CNBC and they are displaying the performance of a certain index or a certain stock, they would use the line chart. Why? Because it's easy, it serves the purpose, it tells me what's going on, but it's not the right chart to use for deep analysis. Why? Because it is only using one element, which is the closing price. That's why I prefer to always use either the bar chart, this one here, or the candlestick chart, which is this one here. Now, of course, the candlestick chart looks way better than the bar chart. The bar chart is dull. However, the candlestick chart is way better. It's colorful and it incorporates all the data available for analysis. It has the open price, the closing price, the highest price, as well as the lowest price. I'm going to take you deeper into candlestick analysis in a bit. You can't see what I'm talking about? Carolina, can't you see my screen? Guys, can you see my screen? I am displaying my screen, yes. Can you see the platform? Can you see the candlesticks? Josephine can't see my screen. Ramavat is saying everything is visible, so I take that the problem is from Josephine's side. But we have also Carolina. So Carolina, can you please, may I ask you to log out and log back in and see if you can, if everything would be fine? Aslan as well is saying he cannot see my screen. That is very weird. That is really weird. Are you watching from your mobile phone or from your laptop or PC? Aslan, mobile phone or Carolina from the laptop? It is very strange because everyone can see the screen except few. All right. Excellent. So let's continue since the problem is not from my side. Guys, whoever cannot see the screen, please log out and log back in. So yeah, my favorite way to analyze charts is through candlesticks. Why? And let's see why candlesticks is a very widely used chart formation globally. Candlesticks charts provide a visual representation of the price movement over a specific period of time. So every candle represents a time period. It could represent 1 minute up to 1 month. If you want 1 year, so every candle can be 1 minute, 1 hour, 15 minutes, 5 minutes, 4 hours, 1 day, 1 week, 1 month, 1 year. You decide the duration of each candle, of each period. These candles reflect the ongoing battle between buyers and sellers in the market. Candlesticks do not just show what happened, but also how market participants reacted during that particular period. It's a live representation of the actions of buyers and sellers. Remember, buyers and sellers are in an ongoing war. Okay? They meet in the market and they fight. Some of them take the buyer side, and want to buy because they think prices are going to go up. Others believe the opposite. They want to sell because they believe that prices are going to drop. So the market is an ongoing war between buyers and sellers. And every candle, you should think about every candle as if it's a battle, one fight in this big war. And of course, we are going to use the information provided by these candles to understand who is winning this ongoing war, who is winning each and every battle in this ongoing war. Understanding candlesticks helps traders read market behavior, not predict the future. However, they are used by traders to predict possible reversals or continuations in the price. The core idea: price reflects expectations in the market. Candlesticks reflect the behavior of market participants. Every candle tells a story about the battle between supply and demand, between buyers and sellers. Reading that story is one of the keys to proper market analysis. You cannot analyze the market without focusing on the price. When I was working in the dealing room 17 years ago, I had a colleague which was sitting right next to me on the desk. Every time I look at his chart, I see it full of indicators. Plenty of indicators, a lot of oscillators underneath the chart, a lot of lines on the candles, Fibonacci's, Ichimoku, multiple indicators all on one chart. You could look at his chart and you could barely see the price. There is no space to see and visualize the price, the actual price. He was too focused on indicators. That using indicators is not wrong, but price is the main element. You cannot hide the price by indicators. You cannot rely on indicators without understanding what the actual price is telling you, because all indicators are derived from the price. The essence, the core, is the price behavior itself. Okay? Now, candlesticks components. Let's understand the anatomy of candlesticks. First of all, this is the candlestick. Okay, it looks like a candlestick, right? We have the body, which is the thick part, and then we have the wicks, which are a thin vertical line above the candle body, and then the lower wick is a thin vertical line below the body. The body represents the difference between the open price and the closing price. So we take the open price, we draw a line. We take the closing price, we draw a line. This range represents the body. Okay, the distance between the open and the close represents the body of the candle. The highest level reach and the lowest level reach during that particular period is represented by a vertical line that cuts through the middle of the body and forms the lower wick and the upper wick. So if I look at this candle here, I know that this is the high and this is the low, right? Now, my question to you: where is the open and where is the close? Is this the opening price or the closing price? Who knows and why? Is this here the opening price or the closing price? Guys, you cannot type in the chat window. You can type in the Q&A window. So whoever is trying to use the chat window should switch to the Q&A window. Muhammad is saying open at the bottom, close at the top. So you are right, but how did you know, Muhammad? It's because of the color of the candle. We use two colors to differentiate between an upwards moving candle and a downwards moving candle. So I like to use red and green. These are the most used colors. However, if we have some girls here among us, you can choose pink and yellow. Others could use blue and white. Choose whatever two colors you want. What matters is you use one color to represent upward price movement and another color to represent downward price movement. So let's decode what we see in front of us here. When I see a red color, this means downward price movement. It means the open is above the close, or in other words, the close below the open. So in this particular period, traders started trading at this level here and ended the trading period below the opening price. So prices dropped, they went down. Okay? When prices drop, who is in control? Sellers. We have more sellers than buyers. Remember what I told you about candlesticks? Every candle represents a period, and every period represents a battle in this ongoing war between buyers and sellers. So what does the color of the candle represent? It represents the winner of this particular battle. So when I see a red body, this means sellers are in control. Sellers won this battle. When I see a green body candle, this means that buyers are in control. Now, this is the most important part, or this is the most important message that we get from the candle, the color of the body, the color of the candle. Now, the color of the candle is important, but you know what's also very important? The size of the body. The size tells me how much control was there by each of the buyers or the sellers. How strong were the buyers or the sellers? So when I see a small body candle, yeah, buyers did control this period, but they were not so strong. They were not very dominant. However, when I see a big candle like this represents strength, momentum, full control, solid control, dominance by the buyers or the sellers. The long upper wick represents rejection of the price. So the bigger the wick, whether it's an upper wick or a lower wick, the stronger is the rejection from the lowest prices reached or the highest prices reached. So three important elements to look at when analyzing a candle: the color, the size of the body, and then the size of the wicks, the upper wick and the lower wicks. Clear? Any questions so far? Anonymous attendees asking why I rescheduled the meeting. I did not reschedule the meeting. The meeting is scheduled at 4 p.m. KSA time, which is GMT plus 4. So, sorry, it's GMT plus 3 in KSA time. And it is 5 p.m. UAE time. Amazing. All right, let's move on. These candles form different patterns. Some of these patterns represent continuation patterns, and some of them represent reversal patterns. And some of them represent no direction at all, such as the doji candle. Doji candle is the academic name, the academic term is doji. Okay, it's a neutral candle. What are the characteristics of this candle? You notice that there is no body, right? The body of the candle is such a small body that it's barely unnoticeable. Okay, we have the opening price, the closing price are at the same level. So what happened during this period? Prices opened at one level, went up, came down, went up again, and closed at the same exact level. So can you tell me who is in control? Who was in control during that particular period? You can't, because there is no clear control by any of the two sides. Now, since the World Cup is about to start and everyone is excited about with the World Cup, think about the doji candle as a game where one team pushed, the other team pushed them back. This team tried to push again, but the game ended with a draw. No one scored. No one managed to advance over the other team. Is there a clear winner? No, it's a neutral candle. Now, a lot of analysts believe that this candle could represent a reversal. This is wrong. Okay. Again, the doji candle is just a neutral candle. It reflects balance between buyers and sellers. It indicates indecision rather than a confirmed reversal. What it requires confirmation from the next candle, from the following candle. Okay. And we are going to see that these candles can appear anywhere. Exactly like a tug of war. Thank you very much. Now, let's jump to the platform again. So if I look at this chart here, let's see here. Okay, prices were going down, a doji candle appeared, but prices kept going down. And then a doji candle appeared, and then price reversed higher. So here, down, doji, more down, doji, up. And then here, down, doji, more down, doji, up. You see, this is a doji, this is a doji, this is a doji, this is a doji. Some of them represents just a pause and price continue in the same direction as before the doji. And sometimes we will see a drop, a doji, and then a move in the opposite direction. So you can say it's a 50-50 chance that prices could reverse or could continue in the same direction. Now we have different types of dojis, the classic, which looks like a plus sign or a cross. We have the long leg doji, which represents high volatility because we have rejection from the higher prices and rejection from the lowest prices reached. We have the dragonfly doji, which looks like the dragonfly that hovers over the lakes. And we have the gravestone doji that looks like a gravestone from the side. Now, some of the analysts believe that the dragonfly doji is a bullish reversal candle. So when it appears, the following candle could go up. And after a gravestone doji, the prices could continue lower. Why? Because here what happened is prices dropped first and then reversed and closed at the open. But to be honest, and then taking you back to the football anatomy, imagine that let's say France pushed, Spain pushed back, and the game ended draw. Can you conclude that the next game France and Spain will play against each other, Spain is going to win because they pushed forward and they did attack the previous game? Definitely not, right? So chances are very slim. To cut the debate, every time you see a candle without a big body, you can simply say, this candle is a neutral candle. It reflects indecision. No need for me to take any action or any assumption of what's going to happen after it. You can see here another example is we have a doji, prices kept going down. We have a doji, price kept going up. Here we have a doji and price reversed from down to up. So honestly speaking, I would never build any conclusion or make any conclusion based on the doji candlestick on its own. Similar to the doji candlestick is the hammer. Okay, it's not a doji, but it's a small body candle. Now, let's talk about I'm going to start with discussing the bullish reversal patterns. So the candlestick patterns that form after a drop and signals a potential reversal to the upside. Okay, we call them bullish. Bullish represents the upward price movement, and bearish represent the downward price movement. Excellent. So what are the characteristics of a hammer? It looks like a hammer, yeah? So here you have the hammer stick and here you have the hammer head. Now it is formed by a single candle. Um, we have a we have a small body near the top of the candle, as you can see here. Uh, we have the head, the hammer head, or the body of the candle is a small body near the top of the range of the candle. Uh, we have a lower wick that is at least 2 times the body size. So if the body size is 10 pips, we need the lower wick to be at least 20 pips with little to no upper wick. So a small upper wick, a big lower wick, and a small body towards the upper range of the candle. Now, a bullish candle, so if the color is green, in my universe, in my color universe, if the color is green, then this usually provides a stronger signal because at the end of the day, buyers manage to advance on the sellers. So it shows strong selling pressure that was absorbed. What happened here? Sellers were in control, sellers were in control. They managed to take the price down. Price reached a level and then a big rejection happened from this level. And buyers managed to take control or reverse the control of the sellers. Okay. However, this battle, the last battle, still ended as a draw between the buyers and the sellers. Small advance from the buyers. What is the market psychology here? Strong selling early in the session, followed by buyers regaining control. Now, the formation conditions, this candle, first of all, the first condition, it must appear after a clear downward move. So I need to have a clear downward move. And then if I see such a pattern, I can say, oh, this is a potential hammer. This is a hammer that could signal a reversal to the upside. Again, we have a lower wick that forms from strong selling pressure, which is followed by a close near the top of the candle. Of course, if this candle appears near a support level or a demand zone, this will increase the likelihood of this candle reversing the price. Okay, this would strengthen the signal that we get from this candle. What is the invalidation of this pattern? A break below the candle's low. So if a candle like that appeared after a drop and prices continued to drop below the low of the pattern, then this pattern is invalid anymore. It cannot be a bullish reversal pattern because prices did not reverse. Price continued lower, and this could happen. That's why in trading, you never enter without a confirmation and you never open position without a stop loss. So you can always control how much you could lose on the trade. Say something happened, okay? Because technical analysis is not magic, it's just a game of probabilities, and new developments in the market could lead the price to go in any direction. So we should always, always, always stay alert and manage our risk, control our exposure. So we always use a stop loss. Let's go and see an example on a hammer. Here, for example, we have prices are going down, 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 and we see a hammer. Okay, notice here we have a body that is small. We have a small upper wick. We have a lower wick, which is more than twice the size of the body. So what happened here? Sellers were in control, push the price lower, prices reach a low, and then buyers stepped in. The candle closed green color, and then what happened? Prices continued higher. Again, prices dropped. And here we have another hammer that appeared, except this time the hammer color was red. Okay, but even though the color was red, we saw a continuation of the control by the buyers and prices went up. So one way to trade these candles is always to buy above the high. So don't buy when the candle closes. Buy above the high and place your stop loss below the low of the pattern. Here, if you want to buy, you either wait for a green candle and buy above its high, or you buy above the high of the actual hammer, even though it's red, and place your stop loss below. Let's see if we have any hammer. Okay, here we have another hammer, which is also red. Prices were going down, and then rejection to the upside. And you can see here that prices dropped a little, but then continued their ascent. Yes, all doji candle represent indecision. If the hammer forms at higher low, it has higher chances of being bullish, 100%. Why? Because now you are looking at the context of the general context of the market. So now you are looking at the trend and you are trading the trend, Ramavat. Excellent. Should you trade on first candle or wait for two candle formation as a confirmation? I mean, one candle is enough if it is appearing within a bigger context. And I will elaborate on this point further. A red color is not an issue, but preferably we prefer to see a green hammer. Okay? We prefer to see a green hammer. However, by definition or in general, a hammer can have any color. Could be red or green. Let's look at another bullish reversal candle, which is the inverted hammer. Again, here, the picture is somehow similar. It should appear after a clear downward move. It's represented by a small body candle, except this time it's not towards the upper range, it's toward the lower range of the candle. We have a small to no lower shadow and a big upper shadow. What happened here? What is the psychology? Although buyers failed to hold the gains, because remember here what happened. Prices were going down, strong control by the sellers. What happened? Buyers took control, managed to push the prices high, but then sellers stepped in again. But what is the psychology? Although buyers failed to hold the gains, this pattern suggests weakening selling pressure and an early sign of a potential reversal. Now, from everything I said now, if I ask you a question, which pattern is stronger? The hammer or the inverted hammer? Which one do you think is stronger? The hammer or the inverted hammer? Ramavat is saying the hammer, Russell is saying the inverted, but mostly we are getting Anthony is saying inverted hammer. No, guys, the hammer is a stronger pattern. The hammer is definitely a stronger pattern. Why? Because look, in the inverted hammer, The session started by control by the buyers, but it ended with the buyers retreating back. Okay, so who had control towards the second part, the end of the period? Sellers. Whereas if you look at the hammer, prices were going down, 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 but the buyers pushed and the market closed on a good note, right? The buyers were in control at the last phase of the period. Towards the end of the period, buyers were still in control. While in the inverted hammer, prices were going down, buyers tried to push, but they were defeated by the sellers. This is a very important development. That is why the hammer is a stronger pattern than the inverted hammer. Okay, now someone asked me, should we wait for a confirmation before we buy? I would say I will never act on a small body candle on its own. So all the reversal patterns, hammer, inverted hammer, and similar patterns, I would not act on them in isolation. I would definitely look at them in the bigger context of things. I would see if they are forming near a support level. If I will always try to combine them with the overall trend of the market, and I would definitely wait for a further confirmation from the next candle. Why? Because they are a small body candle, and small body candles usually signals indecision. They are about to become a neutral candle. So what I like, which patterns I like patterns that are similar to the bullish engulfing patterns. Big body candles are my favorite. Why? Because they represent strong control by the buyers or the sellers. So look at the bullish engulfing pattern. This pattern is a great pattern. It is formed by two consecutive candles. The first is bearish, reflecting control by the sellers. So prices are going down. I have strong control by the sellers, but suddenly what happens is the next candle opens below or at the same level of the previous candle close, and it closes above the previous candle open. So it fully engulfs the previous candle. The control by the buyers in the second candle is clearly stronger than the control of the sellers in the first candle. So the market psychology here is there is a clear shift in control from sellers to buyers. Strong and sudden buying pressure entered the market. How is this pattern invalidated? With a break below the low. If I am to trade the bullish engulfing pattern, I would buy above the high of the candle. So I would wait for the second candle to open. As it is crossing the high of the bullish engulfing, I would buy, and then I would place my stop loss below the lows. Okay? This is one of the best and most accurate patterns in candlesticks. It's a clear reversal signal. Okay, it's a big green candle. Now, one thing I need you to take into consideration. The first red candle should be significant as well. Because if the first candle is big and red, the second candle is bigger and green, this is a clear signal. But if the first red candle is small, it is easy to cover it. It is easy to engulf it. Any green candle can engulf a small red candle. So the reference candle should not be a small red candle. Okay? It should be a decent size red candle to show at least some control by the sellers. Right? And then if this control by the sellers is reversed, then this is a stronger signal. Clear? I love engulfing candles. Okay, they are nice and most of the time they work. Look here, for example. What do you see? Bullish engulfing candle. Here, prices were going down. We have a decent red candle, strong control by the sellers. The next candle opens and it closes above the open of the previous candle. So the body of the candle is fully engulfing the previous. Now, ideally, we want also the open to be lower than the closing of the previous red candle. But this doesn't happen in a 24 hours market, right? Because the Forex market, for example, and the crypto market operates 24 hours, 5 days a week, or 24 hours, 7 days a week. So if you do not have closings for the sessions, then it is very hard to find gaps in the prices, except in the weekend for FX and futures. And for crypto, you will never find gaps except if you are trading the futures. So we tend to disregard the condition of gaps if you are analyzing Forex. Here we can see, for example, here we can see that as prices were going down, we have decent red candle, but then a clear engulfing by a green candle. A clear green candle engulfing the previous one. Where do I buy? I would buy above the high. I would place my stop loss below the low of the pattern. Remember, the pattern is two candles, one red, second green. So the low of the pattern is this here. And where would I buy? I would buy above the high of the green engulfing candle. Yeah. Any questions on engulfings? What do you see here? What do you see here? Opposite to this, right? Can you clearly see that after the bullish engulfing, we saw a bearish engulfing? Prices were going up, showing control by the buyers, a green candle, but then I have a big red candle that is engulfing the previous green one, showing strong control by the sellers. This is called a bearish reversal candle, a bearish reversal pattern. Opposite to the bullish engulfing, it is called the bearish engulfing. It fully engulfed the previous green candle. And if I am to trade this one, I would sell below the low of the red candle and place my stop loss above the high of the pattern. Okay? How to know where to exit? What confirmation do we get? Okay, for me, exit is never an issue because as long as you are protecting your downside as drawdown, as long as you are covered and protected from a big loss, you can exit whenever you want. Okay, now a lot of traders would tell you your risk to reward ratio should be 1 to 2, 1 to 3, 1 to 5. Exit whenever you want, as long as you are making profit, as long as you are psychologically okay with the amount of profit you are gaining, it's fine. You can risk. So let's put it this way. If I'm risking 12 pips, anything, anything, anything equal to 12 pips is good in terms of profit. Okay, so if the distance between my stop loss and entry is that much, you can take 1 to 1 and exit. Or you can exit when you see a sign of reversal. So if I'm selling here and stop loss here, So let's say this is the distance of my risk. Anything up to 1 to 1, 2 to 1, 3 to 1, up to you and how much greedy you are. Okay. If you are trading with the trend, then definitely you can go for 2 to 1. Excellent Ramadan. If you are trading against the trend, picking a trade, trying to anticipate a trend reversal, then definitely odds are not with you, they are against you. So it's better to be conservative and not wait for too long. But usually, if you are trading with the direction of the trend, then definitely by all means go for the upper resistance, go for a higher top, go for 3 to 1, do whatever you want. I'm not very interested in teaching you where to exit because you will exit on a profit. What I care about is helping you pick the correct levels and zones to enter and how to protect your capital in case the market reversed against you. Okay, but definitely in 1 hour we cannot cover everything. So let's focus now on the anatomy of candlesticks and the messages that we can extract from analyzing these shapes, and slowly we will put everything together. So in our upcoming webinars, we're going to cover supports and resistances, trends, divergence in momentum indicators. And once you can combine all these factors together, you could come up with an amazing trading strategy. But again, this is the base. This is the base, or this is the core of any strategy. Because just by adding reversal candles to any strategy, you could definitely elevate the performance of this strategy. You can improve the end result or the outcome of this strategy. A strategy is built by many elements put together. Okay. Yes, strategies should be simple, but at the same time, the more elements you incorporate into your strategy, the stronger or the better the better result it will generate. Ramadan, the actual PDF itself is not available, won't be shared with you, but the recording of this exact webinar will be available online on the Man Markets Academy, and you can watch it as much as you want. All right. So don't worry, you can always come back and watch this material as many times as you want. Now, a similar pattern to the bullish engulfing is called the piercing pattern. The piercing pattern is very similar to the bullish engulfing, but it's a partial engulfing. So the green candle here is not fully engulfing the previous red one. It's engulfing more than 50% of it. So we have clear control by the sellers, prices open, and then suddenly buyers are taking control. They reversed more than half of the control of the sellers in the previous candle. So the second candle opens below or near the first candle close. Yes. And it closes within the first candle body above 50% of its body. So I need the green candle to reverse at least 50% of the distance covered by the sellers in the previous candle. Again, which one is stronger? The bullish engulfing or the piercing pattern? Of course, the bullish engulfing. Because, why? Because the bullish engulfing is reversing all the previous bearish movement, while the piercing pattern is only recovering partially the control by the sellers. Let's try to find an example of the this is an example of a piercing pattern. Okay, notice here what happened. Prices were going down, strong control by the sellers. One, two, three, four big body red candles. And then I see a green candle that opened near the closing price of the previous red one and went up and covered more than 50% of the red body candle, previous red body candle. Okay. Yeah, one to one. We saw one to one upward movement. So again, if you had entered this trade, it would have worked. But because it was a counter trend trade, you shouldn't wait for long. Okay, and pay attention to one thing. When it comes to piercing pattern, the first red candle, the bigger it is, the better. Again, the same thing with the with the bullish engulfing. We need the first red candle to be big to represent strong control by the sellers, and then we reverse the control of the sellers with a big green candle. But the bigger the red, if the reversal happens, the stronger is the reversal. Let's go again and cover few more patterns. The harami. For me, the harami is a pregnant lady in Japanese, and you can understand here why the name harami, pregnant, because the second candle, okay, the green candle, is a small body within the body of the previous red one. So it's not as strong as the bullish reversal candle. It's still a reversal candle, but you see the color of the green is smaller than the red. The green candle is smaller than the red. It is contained within the previous range. So definitely it's not as strong. A nice candle is the morning star. The morning star candle is a three pattern candle. So we have, it comes after a clear downward move. First candle is big and red. Okay. This is signaling controlled by the sellers. Then we have a small body candle that looks like a doji, like a hammer, like an inverted hammer. It's a small body candle. It could be green, it could be red. We don't care. This candle represents indecision or shift. It represents the weakening side of the sellers. And then after the small doji, which could be a hammer, a doji, an inverted hammer, it could be a dragonfly doji. Then what do we see? We see the third candle, which is a strong, big body green candle. So what happened here is a gradual shift in control from sellers to buyers. Sellers control, indecision, neutral behavior, and then strong control by the buyers. So we have this gradual shift, control by the sellers, no control anymore, draw, indecision, and then strong control by the buyers. I like the morning star and I like the evening star. So these are the two best formations, the bullish engulfing and the morning star for bullish reversal patterns, and the bearish engulfing and evening star for bearish reversals. You are most welcome, guys. You are most welcome. Yes, I will be giving the recording. The recording will be posted on the Man Markets Academy, and I'm sure tomorrow you will be contacted by the team from the Man Markets to explain to you everything you need. And Ramavat, you are a pregnant lady. Excellent. Okay, so let's go and try to find some examples of the morning star, the evening star. Okay, all right, all right. Where is the morning star and evening star? Now, this is an evening star. I already highlighted this. Look here, prices were going up. The big green candle, small one, and then big red one, covering more than 50% of the green one. This is the evening star. This is the evening star. Um, let's see if we can. Here we have also the morning star. We have one big red candle, one small green, indecision, and then controlled by the buyers. And my what I'm interested in is that this candle closes above 50% of the red. It should reverse 50% of the distance that was covered by the sellers before. And here you can enter above the high of the green candle and place your stop loss below the low. Okay? So here you could enter above the high and you can place your stop loss below the low. Of course, this is a counter trend trade, yeah? Because the trend is down and you are picking a trade against the trend. Now, strong patterns like these, if they are traded with the direction of the trend, you will be simply increasing your probability of success. Okay? So here, this trade was with the direction of the trend because you can clearly see that prices are going down. They stabilized here, and then it's a trade. Let's think about it this way. It's a trade downwards with the direction of the previous movement before this consolidation zone. So prices do not move in one direction all the time. We would see one directional move, consolidation, and then continuation or consolidation, and then reversal to the other side. Looking forward to seeing you all. Stay in contact, and I hope you enjoyed this session. Looking forward to seeing you soon. Ciao.